Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in this very important webinar on impairment assessment during audit. And in order to tackle this very important topic, which is a very apt one during the post-COVID, we are having with us our very eminent and learned speaker, C. Vishwaranjan Sutarji. So, on behalf of AASB of ICI, I extend my heartiest welcome to you, sir. Welcome to you, sir.
Thank you so much.
I also extend my warm welcome to all the participants of today's webinar. It is my due to some urgent meeting, Honorable Chairman and Honorable Vice Chairman sir are busy in some other meeting. So in absentia, we are going to start our today's webinar, and it is my proud privilege to share with all of you the brief profile of our today's learned speaker, Shri Vishwaranjan Sudhar sir. Shri Vishwaranjan Sudhar sir is a rank holder in commerce graduation, a fellow member of the Institute of Chartered Accountants of India, and an alumni of IIM Calcutta. Mr. Part, can you mute? He's a chartered accountant from the Chartered Accountant of India and alumni of IIM Calcutta. Currently, he is working as a partner with Messrs. SRNB and Associates. Before joining SRB has worked with Messrs. Deloitte Haskins and Sells, and he got vast experience in auditing of large sector listed companies, public sector undertakings, and banks. Apart from assurance services, being a certified IFRS professional, he is involved in large number of gap implementation and valuation and related consultation to the various entities. Further, he has delivered number of lectures both in-house as well as outside training and corporate trainings to the various academic and professional institutions like Institute of Chartered Accountants of India, Institute of Company Secretary, IIPM, etc. on various subjects like valuation, startup, Schedule 3, PARO, audit and assurance standards, and various standards on auditing. So once again, I welcome you, sir, on this platform and on this very important topic which we are going to organize in the form of webinar. Welcome to you, sir. So now.
Thank you so much. Thanks so much. Very good afternoon to all in absentia, Chairman ASPC and Vice Chairman ASB. It's actually a privilege to discuss any matter with our alma mater, any given. But talking on a subject which is very profound today, which is very critical, and many times, whenever we have done this kind of work, we feel the artists on this issue, particularly impairment assessment during audit, has always taken backseat. We'll be discussing why we taken a backseat. I congratulate ASP and the think tank behind it, structuring this topic for regular deliberation. So thank you once again, and give me a second once I send my screen. Yeah, if someone can confirm you whether the screen is properly visible.
Yes, sir, it is visible, sir.
Yeah, thank you so much.
Thank you, sir.
Look, impairment assessment during audit. Assess impairment in particular times of today, where the ecosystem is on a crossroad. When I say at crossroad, we're just recovering from, or yet to recover from COVID. And already we are knocking the door of recession, and we are also seeing the rate changes. All couple these factors in any way is going to impact any business cash flows. And when you talk about impairment, it is very much the comparison between your carrying value of any business you do and the recoverable amount cash flows you are going to earn out of that particular carrying amount through assets of business tomorrow. So this comparison is going to have an impact because of this scenarios, and which is very volatile and every minute changing scenario. So it is very critical to understand this impairment assessment during audit for all of us. Before I jump into the topic, I'd like to give you a few backgrounds of this impairment assessment. Then we'll go deep dive into this. Before we start, everybody would understand or read this quote from Stephen Law, where he said we didn't do anything wrong, somehow we lost. It's a very great and renowned quote from Stephen Law, who was ex-CEO of Nokia. When Nokia was doing wonders for the company, suddenly they are out of the race. And what happened post that? They got impaired. The entire business got hugely impaired. And if you visualize this aspect and recognize this aspect in our day-to-day environment and with our clients, you'll visualize that in most of the clients where they have either gone for NCLT or during COVID, they have not done that good. But when you compare this situation to our previous year audits where we have not done or said anything on impairment, and suddenly that client or the business has gone down, then somewhere we have missed in the assessment of this impairment. So that's why I brought this line from Stephen Law from the first slide itself, because this talks about the concept of impairment and why it is critical for our audit engagement for each and every client. Now, giving the broad scope of this to our discussion, we'll talk about scoping of impairment, then we'll talk about Ind AS 36 vis-a-vis AS 28, because impairment will talk morely related to PPE, though there are impairment related to other assets. We'll discuss it. Then we'll be discussing, since it is focused on auditing aspects of impairment rather than the accounting technicals. So we'll be discussing what are the steps we generally follow or we should follow while assessing this impairment in any of the clients. So first going first. If you see the impairment, there are a whole lot of many things which is appearing in our balance sheet or in the financial statements needs to go for this impairment testing, but not necessarily with respect to Ind AS 36. So there are certain inclusions and exclusions. As far as Ind AS 36 or AS 28 is concerned, the things which need to be tested for impairment in the manner it got disclosed is property, plant, equipment, intangible assets, and investment in these assets and joint ventures. These are the inclusions in the scope of Ind AS 36. But if I compare it to with AS 28, which there are many companies still follow the accounting standards wherein this investment in subsidiaries and associates joint venture are not dealt with. But as far as Ind AS 36 is concerned, this investment in subsidiaries, associates, and joint ventures are part of the inclusion scope. As far as the exclusions are concerned, where the respective standards are there to deal with and not a review of this. Those are inventories is dealt in Ind AS 2 contract assets and assets arising out of contract and revenue contracts. Ind AS 115. Then you talk about deferred tax assets. Ind AS 12. Then assets arising out of employee benefits. Ind AS 19. These are the things like financial assets. Ind AS 109. Biological assets. Ind AS 41. Insurance contract. These are separately done, and how these things to be dealt with have been explained in those respective accounting standards. Now coming to Ind AS 36 and 28 comparisons, what basically impairment means? Impairment means at present you got a carrying value of assets, that basically your business value, and you compare this business value with the recoverable amount. What is that recoverable amount? Recoverable amount is always the value in use or higher of fair value you fetch by selling or disposing of that asset. And you compare this value in use with or the recoverable amount with the carrying amount. If your carrying amount is higher than the recoverable amount, you account for impairment loss. This is technically in pure terms, simple terms. This is what impairment comes into this picture. Now, as far as accounting standards are concerned, business ecosystems are concerned, what makes this impairment assessment little tricky or to little more amount of thought process to get in is the subjectivity involved with the impairment assessment. For example, when you built in the cash flows or you arrive at value in use, there are a lot many factors which comes into play. For example, your future forecast, your if you are in exports, your foreign currency risk, your market risks, all those subjectivity comes into play as far as computation or building this cash flows are concerned. That's how it gives the challenge for the auditors to test impairment critically. And of late, what has happened, these valuations are more or less narrative driven than number driven. Because if you see of late, the kind of valuations we see in the market also, there is no correlation between the numbers and the valuation numbers we get. It's numbers with the financial statement numbers. So there is a lot of amount of siftings has been done. If I brought this siftings, what has been done is like we mostly value a particular business based on the stories revolved around its business and being told to stakeholders rather than going or venturing into the real numbers. As an auditor, when I supposed to do impairment assessment or test the impairment assessment, understanding the stories behind those numbers, it becomes more critical. So I need to understand how the ecosystem goes into this. Now, of course, yes, the accounting about indicators which gives me the sense of when this testing has to be done, how the testing should be done. To clarify on a very broad terms, because as I said at the beginning, we are not going to detail into the accounting standard part of it. Rather, we'll focus how the practical aspects come in as far as auditing this impairment assessment is concerned. So talking about the accounting standard aspect of it, if I speak in terms of Ind AS 36 or AS 28, it talks about first you identify the indicators. And it is not necessary that every asset has to be tested for impairment every year. That except real and intangible assets. This is not there in AS 28, but in AS 36 talks about that you test goodwill and intangible assets every year, irrespective of whether there are indicators or not. But as far as remaining assets other than goodwill and intangible assets are concerned, those has to be tested for indicators. And those indicators could be external or internal. Like if you see the indications of unexpected in the market value, that is for market capitalization, or significant negative changes with respect to technological market and economics. Like we talked about the Nokia CEO's quote, which so it is because of the change in technology. So these are the external informations like market interest rates or other market rates of return of investment have increased, or carrying amount of the net asset of the entity is more than its market capitalization. These are the external source of information. What are the internal indicators where we can say that there could be a possible instance that we need to test for impairment for the management? There could be evidences available of obsolescence or physical damage of an asset. There could be evidences available for internal reporting that indicates the economic performance of asset is going down, or there could be a significant negative changes in the context to which an asset is going down. So there are a couple of external and internal source of information or indicators are available. Then there are other indicators. Coupled up with this, if the management feels no, there could be a possible affirmation to the indicators that this value, what we are carrying in our financial statements, are going to be lower, higher than the what are the amount we are recovering from these assets in future, then there's a possibility of carrying out the testing of impairment. Now coming to calculate this impairment, there are factors, as I said, and there are subjective parameters gets involved in. So what an auditor should do or take steps to make this impairment assessment a perfect one. As I said at the beginning, impairment is something which always have taken a backstage as far as our audit is process is concerned. And as far as disclosures are also concerned, there are huge amount of misdisclosures been done as far as impairment accounting standards is concerned. So fundamentally, I've divided it into 8 to 9 approaches where we should go in and dive in how impairment testing should be tested in an audit approach. So first thing first, the step 1 is start early. I still believe in that golden document called SA 315, Auditing Standards 315, which talks about knowing or understanding the entity and its environment. I still love that document. And if you visualize our auditing process, how we started, this is one of the pure initial documents we built in to understand the business under 315 of AS. What this document talks about then? This document actually talks about everything about the business, and gives us to build the risk matrix as far as the sampling is concerned. Then you may ask me right now that how it is connected to our impairment testing. Look, impairment testing is basically understanding the business, how the business is going to flare up tomorrow. If I know the business, there are inherent risks, and the tomorrow's business is not that clear, then there is a signal of impairment because my business is going to down, and whatever carrying value of assets I'm holding today is not going to hold good tomorrow. So start early. And impairment testing, as I said, we discussed at the very beginning, as far as goodwill and intangibles are concerned, you can test it at every given point of time in any annual reporting period. It's not necessary that you evaluate it at the every end of reporting period. It can be done during the year also, but make sure that every year it is being done at the same time. So the starting early is key, and please make sure that it is properly documented and you start early things. Then next. Yes. Step 2 is the disclosure requirements. This should form part of our kind of checklist, because the kind of work I'm going to do with my impairment assessment should be strictly based on my audit plan, and I should have the proper checklist with me to have that testing done. And this checklist should be evolved around our disclosure requirements of Ind AS 36, because Ind AS 36 or Ind AS 1 talks about many things, many disclosures, and normally it is always a miss as far as company is concerned. So, like key assumptions on which management bets its cash flows projections, the period over which cash flows are projected by the management, with an explanation for a period of more than 5 years, as you say, or the growth rate used to extrapolate cash flow projections beyond the period covered by the most recent budgets or forecast, or justification of any growth rate that exceeds the relevant long-term average growth rate, etc. So all these disclosure requirements, we need to take it in concurrence and make a checklist of this all parameters while you jump in before impairment assessment. So second step should be disclosure requirements. Third is most important aspect of Goodwill as far as today's business scenario is concerned. Why I'm talk of Goodwill in step 3 is, as I said at the beginning, Goodwill is something which can be tested, which has to be tested every year. and can be tested at any given point of time. And Goodwill testing is very typical because if you recall AS 28 and the Index 36, there is a huge change conceptually as far as Goodwill accounting is concerned and impairment of Goodwill is concerned. How this Goodwill arises in our books? First, we need to understand that. So there could be many situations which trigger this Goodwill number in our books. Be it erstwhile, say AS 10, 14 or 21, or in new generations, Goodwill arises because of the business combination. And this Goodwill, whatever gets raised because of this business combination has to be allocated to different CGUs. Now, this allocation, how I allocate, how the management allocates Goodwill to different CGUs across the tenure, there is a conceptual gap between Index 36 is concerned and AS 28 is concerned. Because AS 28 talks about bottom-up or top-up approach, which is not there in Index 36. And it talks about allocation of Goodwill to all CGUs. It gives the idea that to the lowest of the assets, how the management foresees that Goodwill impacts that particular lowest of the asset segment to which it belongs to has to be allocated that way. So once Goodwill is allocated, then the impairment testing, because Goodwill is something which on its own cannot generate cash flows. So, so the recoverable amount of Goodwill as an individual asset cannot be determined. However, Goodwill often contributes the cash flows of individual or multiple CGUs. Therefore, Goodwill required in a business combination is allocated from the acquisition date to each of the acquired CGU or group of CGUs that are expected to benefit from the synergies of the business combination. Determining the recoverable amount of the Goodwill then becomes part of determining the recoverable amount of the CGU or CGUs to which it has been allocated. It becomes critical. So it is very prominent to think that how the Goodwill is going to be subsequently tested for impairment before finalizing the allocation process. So that could be an example I can narrate it. So for example, say A acquired 100% of entity, say of B, and it allocates Goodwill, recognized Goodwill, identified 4 CGUs wherein the Goodwills can be allocated. So entity A now management is proposing to allocate Goodwill to these CGUs based on their expected profits. So this method of allocation is not appropriate because expected profits should not be used as the basis of allocating Goodwill, because CGU relative profits will change on the basis of prices set by the CGU management. And because such allocation process takes no account of the benefits that the acquisition will bring to each existing CGU. So entity A's management should identify a non-arbitrary or reasonable and consistent basis to allocate Goodwill to the CGUs. Such identification will be primarily based on where the synergies are expected or where the assets that can be separately recognized from Goodwill are located. One practical way of management would allocate Goodwill to CGU is based on the relative discounted cash flows of the CGUs, especially as this is how it will be subsequently tested for impairment. So there has to be a solid reasoning how you allocate Goodwill amongst CGUs. And this reasoning has to be substantiated with reasonable reasonings. Step 4, again, one of the critical things to do it, and especially in today's time, it is more critical because nowadays, because of no boundary, we are living in a no boundary world, and every business, even a small city, small business, they have a foreign transaction. So foreign currency cash flows plays a pivotal role in impairment testing, and normally we fail to understand this aspect while we test for impairment as an audit part. Because foreign currency cash flows are common and required to be dealt. Suppose, for example, I'll give you one example to appreciate this fact more clearly. Say one entity is determining future cash flows for an impairment test of a CGU containing say fixed assets. So in as far as Index 36 is concerned, how the future exchange rate movements taken into account where the cash flows are to be received substantially in foreign currencies and will occur over say 5 years period. So considering the volatility in the market, the way foreign exchanges are getting volatile due to many factors which plays into this, the future cash flows are estimated in the currency in which they'll be generated. Suppose we are billing in say in USD, then discounted at an appropriate rate for that currency. Now, this discount rate may not be easy to determine. Why? As it is likely to be different from the rate used in the remainder of the present value. Because suppose my entire billing is in INR, so the discount rate I take for building my future cash flows and arriving at value in use is not the same when my value in use is depend on the foreign currency cash flows in future. Because foreign currency cash flows are open to country and currency risk specifically more. So it is not only risk is available as far as INR is concerned. Foreign currency, if I am dealing with foreign currency and there are foreign currency inflows, it is prone to both country and currency risk specific. So how to do it then? Then the present value of the foreign currency cash flows are then translated at a spot rate at the date when the impairment review is being performed. A more reliable estimate for future exchange rates could be the current rate than the current rate cannot be made. So Index 36 provides the use of forward rate existing at the date of impairment review. So if there is a foreign forward exchange contract is in place, then it plays again a double sword game. How it plays? This will meet the definition. Suppose there is a forward exchange contract available in the company, then it meets the definition of a derivative, and it is measured at fair value in accordance with Index 39. So inclusion of the contracted rate in the cash flows for the fixed asset impairment test would mean that the cash flows are fixed of the foreign exchange contract and would be double counted, both in the impairment testing for the fixed asset as well as supporting of the financial assets or the liability on the balance sheet relating to derivative. We'll take an example to understand this. Let's take a company who is say in UK, and it has 50% of its sales in the UK itself, and another 50% of the sale is made in US. So management has prepared its discounted cash flows for impairment testing in the foreign currency for the portion of sales relating to USA. So during the year, say hypothetical numbers you take. So during the year, following a certain rise in rates, say management decided to enter into a forward contract to sell dollars arising from sales at a fixed rate. So the contracted forward contract rate for €1 is say equivalent to $2.5. Since entering into the contract, the exchange rates have fallen, and the current spot rate is say €1 equal to say $1.9. So translating this forecast foreign currency cash inflows using the spot rate of say now the spot rate is 1.9 USD as acquired by Index 36. The entity does not have the impairment of CGU because the recovery amount is far higher than the carrying value. But at the current spot rate, the forward contract is the underwater, and that would be a liability because it's a derivative contract, and then the balance sheet for the derivative. So applying that is the standard, the impairment testing incorporates spot rates into the calculation of recoverable amount of the CGU, which reveals no loss. However, a loss to the entity arises from entering into the derivative, permitting the entity to convert dollars to sterling at a rate that is less favorable than the market rate at the year end. And this loss is attributed to the derivative. The loss has therefore been allocated to the instrument that has been given rise to it. So when We are assessing the impairment cash flows, especially with related to foreign currency cash flows. We should be typically very sure of what rate we are taking for discounting. And if there is a forward contract, then that derivative loss has to be factored in. So be watchful when the management gives you cash flows, which includes foreign currency cash flows. So that is step number 4. Step 5 is to compare. What to compare? See, you can compare likewise, like to like, you can compare. When you're building cash flows are based on various factors of assumptions and presumptions. So those assumptions and presumptions has to be related to a particular industry in which your client is dealing with or related to the client itself. So make sure that the cash flows being tested are consistent with the assets being tested. Watch for consistency when including or excluding working capital for the CG. Also make sure that the forecast cash flows make allowances for investment in working capital if the business is expected to grow. In principle, cash flows relating to assets that generate cash flows independently. I repeat, in principle, cash flows relating to assets that generate cash flows independently of other assets are excluded from the forecasts because they are also excluded from the carrying amount of a CG. For example, you include financial assets such as, say, receivables. So your forecast cash flows include cash inflows from the settlement of trade debtors outstanding at the impairment test date. You include if there is an inflow against those receivables in future, because this will result in higher net cash inflows in future. So trade debtor should be included in the carrying value of the CGU. If the future forecast cash flows are not inclusive of the collections made from debtors outstanding at the impairment test date, then the result is lower of the net inflows. Then trade debtors should be excluded from the carrying value of the CGUs. So you compare, and the comparison has to be on like-to-like basis. I'll take another example with creditors. Say if you are forecasting cash flows including cash outflows of the settlement of trade creditors today. If yes, then this will result in lower net cash inflows tomorrow. So trade creditors should be included in carrying value of the CGU. But if you are not forcing that those trade creditors has to be paid tomorrow, which will rise higher net cash inflows, then the trade creditors should be excluded from the carrying value of the CGUs. So your comparison between your cash flows and the carrying value of CGU has to be likewise. It cannot be different. So cash flows should exclude cash flows relating to financing, which include interest payments as liabilities excluded from the carrying amount. And because of the cost of capital is taken into account by discounting the cash flows. Many entities, I've seen with my limited experience, many entities while preparing cash flow forecast for the purpose of impairment testing, base the forecast on the underlying cash flow forecast for the business. These include cash flows from the settlement of working capital, balances at the year end. So the standard permits these entities to leave the forecast unadjusted as long as the carrying value of this CGU is increased by the amount of working capital assets and reduced by the value of working capital liabilities. So please take a note of this. Please take a note of this when you build in your cash flows, and that built-in cash flows are incomparable likewise with the carrying value. So this is two factors I have just given. There could be many factors. So always have a overall comparison between the cash flow and the carrying value, and make sure that it is a like by like comparison is established. Then next step is reconcile the conclusion of the current environment. This is more critical. What is this? Suppose you have done all your calculations, whatever you have done, finished with your detailed calculations, ensure as cross checks been done, and the final answer makes sense by comparison to external market data. Everything is done. The current economic climate assumptions that were reasonable a year ago are possibly no longer reasonable, because the cash flows are based on many factors, and those factors has to be reconciled with the current scenario. You should ask the question to yourself, the factors I've considered building this cash flow, is it holding good today? And is it going to hold good tomorrow based on the current situation? So that reconciliation of each of the things is critical. Say consumer confidence is falling or the economic outlook deteriorates, and this is having an impact on the consumer spending. So reduced spending is affecting many industries, not just banking or property or cash flow growth in FMCG sector. So assumptions should be therefore be reviewed carefully and compared to up-to-date economic growth forecast. So unless we reconcile these parameters what been built in forming those cash flows with the current scenarios, then there could be a possibility that we have gone grossly and widely wrong as far as our impairment testing is concerned. So it is possible to obtain analyst report to minimize the gap between the numbers, the story, and the assumptions. This should be considered, what this should be, the analyst report should be considered as an evidence to support the growth assumptions. And it should also be worth reviewing comparable deals and multiples implied in these deals versus the implied multiples and valuations inherent in any impairment test discounted cash flow calculations. So there are outside evidences we should try and inbuilt while reconciling what the management has given the forecast model and what the actual outside market is talking of. And as a part of our audit process, we should reconcile on these parameters that the assumptions taken by the management and the cash flows built in by the management actually is sustainable based on the current market scenario. And if those there are deviations between the current market scenarios and the basis on which cash flows are built in, then we should factor in and get the cash flows aligned with the current market scenario. I'll talk about few examples, like in COVID times. Suppose you talk about, say, petroleum companies, where the crude price has gone negative, and companies are supposed to forecast their crude thing for the next 15 years. And if you today see the crude price, there is a pendulum jump and swelling of crude prices. So this volatility has to be factored in with a longer period horizon, and outside technical evidences has to be collaborated and correlated with the cash flow built up made by the management. Then only we can sustain that yes, this cash flows built in by the management is appropriate and the impairment test is proper. Unless otherwise we do these things, then it is not going to hold good. Next is market capitalization. It is one of the indicators when we discussed initially that while testing the indicators whether the company should go for impairment testing other than goodwill or intangible assets, one of the elements was market capitalization. Some year back, if you ask me, this market capitalization is not that critical parameter for evaluation of impairment, I would have agreed to this statement. But considering today, it opens up many dimensions to our impairment testing, because market capitalization is one of the solid benchmark indicators which throws the value in use compared to your carrying value. Because what is market capitalization? Suppose, say, talk about a X listed company, and that listed company at today's price, it is valued at say 100 crores. But when you see the book value, it is around say 150 crores. So there is a quite gap between market capitalization and the book value. And how it translates in real terms, if I ask the company, or company wants to sell all its shares to, or transfer all its ownership to in near future, then it has to transfer all its near shares in near future around the number of its market capitalization, which is say 100 crores for our discussion. So if this is the case, then I can say that your book value is overvalued by 50 and impaired by 50. Is this statement is going to hold good? I'll say the statement is not going to hold good perfectly and 100%, because there are many factors which impact the market capitalizations. And today, these market capitalizations are not solely driven by the business scenario or the reportings. It is more of a story built or narrative based market behavior than the business behavior. You talk about the recent things which is happening, say, with the PayTM or Zomato or many startup companies recently which got listed. The kind of valuations they demanded or commanded at the type of listing and the valuations there today actually, and compared to their book value, there is a huge gap. So while factoring in this market capitalization, yes, it is one of the profound indicators available, and this market capitalization indicator is again external, and so it is that much profound. We should give a sense of thought to this market capitalizations while we build in our impairment assessment. But there are a few things we need to take care of it. First, you make sure that this market capitalization gap between market cap value and your carrying value is wide enough and is consistent enough. Suppose because of say COVID, when you see COVID, when it fall down on the first lockdown got announced in March say 2020, suddenly the market has crashed. But that has nothing to do with the business. It is the sentiment which drove the market devaluation. So I cannot say that that devaluation in the market capitalization will lead to impairment of the carrying value. So this market capitalization and carrying value gap has to be consistent, and one should see on a very longer horizon. If this gap persists over a period of a normal cycle, say if the business is not cyclical, then it is there for a period of 3 years. The same gap is there for the business period of 3 to 4 years, and understand why this market capitalization is lower than the carrying value. What are the factors which contributes this market capitalization gap with the carrying value? And if those factors or parameters contributing this lower market capitalizations are related to business, technology, or economic scenario, then one have the right call of impairing the assets. Otherwise, purely based on market capitalization, one should not go and jump in the conclusion that this business has this CGU particular CGU has impaired, and you make account for that gap. So one need to pay key attention to market capitalization, and you should judge this market capitalizations over a period of time. Discount rate. I kept it knowingly towards mid of our discussion, because discount rate is one of the factors, or I'll say one of the critical factors which can swing your valuations, which can swing your cash flows, We can always change the number and always increase the gap between the carrying value and your value lineage. There are different aspects to look into this discount rate, and we need to understand what this discount rate is and how it is getting used and what role it has in all the game of competition or impairment assessment. See, as far as standard is concerned, it talks about risk-free interest rates that set by the central bank uh, in any territories that to be taken as discount rate. But is it so? It all depends in what scenario the company is operating. What is the mix as far as companies funding is concerned? All those comes into play as far as choosing the appropriate discount rate, as far as building in the cash flows and discounting it to get the value news. So watch out for illogical discount rates, because many companies, they just in Excel put one rate which suits the calculation. We just give them the required number. So instead of looking into the number, watch out for those illogical discount rates. The risk-free interest rates set by central banks are falling in many territories. So, but other factors affect the discount rates as well, and that is more important for impairment calculations. This could be and include corporate lending rates. That could be more broader in term. Cost of capital and risk associated with the cash flows, which are all increasing in the current volatile environment and may well result in the increase in the discount rate. So it is not only the risk-free interest rate you should be concerned about. You should always talk factor in the capital and risk associated with the cash flows. You also factor in the corporate lending rates. So many companies, what they do, they use the capital asset pricing model to determine the discount rate, which is more or less appropriate. So many of the inputs into this model will have changed given current market conditions. For example, with many national base rates are increasing and decreasing over the period, because we have seen pendulum swings across the board as far as the rates are concerned. The risk-free rate of government bonds, which is there a year back, is not the same this year. There is a huge gap. So we'll have and our risk premiums have gone up, which may more than offset this fall. So you choose a discount rate which is apt and which has factored in all the aspects of that business risks, currency risks, and country risks. Then you take the discount rate to factor in your cash flows. So watch out for illogical discount rates. If I'll give you an example. Say group's business includes a water utility or a biotechnology subsidiary. So the water utility has a lower risk profile than the biotechnology subsidiary. So the biotechnology subsidiary was financed entirely by a debt formation. So the water utility was financed by debt and equity mix. So you got one segment of assets which is funded by debt, and another segment of asset which is got funded by mix of debt and equity. So debt is secured on the assets of the entire group. Now the divisions are got separate SHUs. So the discount rate used to test the biotechnology asset. So to repeat again, the biotechnology assets got entirely created out of debt at formation, but water utility got formed by way of debt and equity funding. So the divisions got two SHUs. So discount rate used to test the biotechnology assets for impairment should be derived individually. It will be greater than the rate used for the water utility due to the greater risk in biotechnology sector. So as I said, discount rates are not purely driven based on your borrowing rates or risk-free interest rates set by the respective central governments. It should also factor in the currency risk, country risk, and the business risk. So the rate to be used in is not driven by the actual cost of capital contributed to the SHU in case by terminology. So by virtue of the financing structure adopted by the specific entity. but should be a risk-adjusted rate specific to the asset being tested for impairment. So discount rate plays a very critical stepping stone as far as any impairment assessment is concerned, and for each and every company. So more focus should be there to understand and make sure that the discount rate adopted by the company or the entity is apt, and it is not necessary that the discount rate has to be equal for across all the SIGs. There could be situation where you need to take concurrence of different discount rates for different SIGs based on what risk scenarios placed down in the respective SIGs. Next is value in use itself, because as I said at the beginning, as far as understanding impairment is concerned, it is simple. In layman's view, you have a value which is your carrying value, and you arrive a recoverable amount which is your fair value of that asset if you dispose it of, or value in use, which is for you are going to earn by using that asset in future course of time. So this value is more critical. So while building this cash flows, there are few things which as an auditor we should keep in mind. First, is this forecast being done for a period which is not higher than the useful life of that particular asset? Because I'm assessing the value in use or future cash flows based on a particular asset or CGU. If say per se the CGU's remaining useful life is in 10 years or 6 years, then my future cash flows to arrive at the value in use should not be more than 6 years, because after end of sixth year, that asset itself is not going to be there. So my value in use should be restricted to the lifetime of that remaining useful life of that asset. Second, the standard is critical and strict on the competition of future cash flows based on your production capacity. Suppose I'm talking about impairment assessment related to a manufacturing setup. Now, this impairment is always based on an existing condition of the assets. So whatever value in use I'm going to calculate is based on the existing conditions of asset. So it should not factor in future modifications which might, again I'm repeating, it should not factor in future modifications which might arise to increase in production capacity. So if in the capital budget there are future restructuring plans are there to the asset, or capacity building plans are there to the asset, then both the cash outflows and inflows should be out of this computation of value in use. So in calculating value in use, future cash flows should be estimated for the assets in the current condition only. So key constraints concerning the assumptions that can be made in value in use compliant cash flow forecast related to future restructuring or reorganization and capital investment should be discounted for. So the cost and benefit of a future restructuring should not be recognized in cash flow forecast unless the entity is committed to the restructuring and the related provisions have been made already. So my cash flows are based on a particular asset which is existing today. So the cost and benefits of future expenditure that is intended to improve or enhance the assets or business should be excluded from the future forecast cash flows. So the practical implication of this is that the cash flow forecast for a value in use taste may differ from the cash flows in the broad approved budgets. So many times what happens, the client comes in and they say, boss, look, we have done the cash flow forecasting and this has been approved. And what has been approved? The capital budget and future revenue budgets. So those are not the cash flows which you require and which should be considered for impairment testing. So the practical implication of this is that the cash flows forecast for a value in use test may differ from the cash flows in the board approved budgets for future years. For example, where the management has approved, say, restructuring plans. So the most recent formally approved budgets are likely to include both the cost and benefits of the planned restructuring. However, However, the accounting for the restructuring provision may be delayed until post-balance sheet if the plans have not been communicated to the impacted by sufficient detail. So in this case, forecast would need be adjusted to remove the related cost and benefits of the restructuring. So when you arrive at value in use, please make sure that future modifications for is factored in is not part of your computation of forecasted cash flows. This is value in use. Now, step 10 is to make sure that whatever you have done or the management has given to you is reasonable and supportable. And this is more critical of it. As I said at the beginning, when you compare your carrying value with the value in use, many a times this value in use are based on assumptions, and these assumptions based or revolved around a future greenery story built in by the management that this will happen, that will happen, all those things. So there is no issue admitting those assumptions, but those assumptions make sure that are reasonable and supportable. For example, suppose I'm talking about building a cash flow of an existing machinery, which is CGU, and that machinery is near about 95 to 99% fully utilized. But the management given me a cash flow, and that cash flow got cash projections which factored in both price escalations and production increment. She would tell me in what way the machinery which is fully utilized today will have production increment tomorrow. It is not possible. Yes, there could be a price increment because of inflation or everything, but there cannot be a production increment to the existing machinery because already it is already been 100% utilized. So that factor has to be discounted for. So this way, like for example, the petroleum example I have given, the crude Brent prices I have given. So how realistically you can measure, because accounting standard talks about you measure in a real term basis, say 3 to 5 years or 5 to 7 years time. But to meet the requirement of testing and to make sure that there is no impairment, normally clients they do testing of say very long period, 15 years, 20 years, 25 years. So as an auditor, you need to justify how far this building of cash flows over the period of 10 years, 15 years, 20, 25 years is reasonable and justifiable. What amount of supporting documents or textures or text or analytics service will be helpful to justify this thing in reasonable terms as far as value in use is concerned. So this is related to reasonable and supportable things as far as testing of impairment is concerned. Hello. Thus far, is there any questions from any of the participants? Um,
Sir, can you hear me? 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 Hmm? आवाज करो. Thank you so much, sir, for wonderful deliberation, respected members. There is a very heavy rain in Odisha, and power cut is there. So therefore, honorable speaker is not able to log in again. So it is not possible now to reconnect again. I have already discussed with him over phone. So there is a lot of rain over there. So that is why it is not possible to log in again with this, because the connection has gone out. And over phone, I have discussed with him. There is a lot of problem to reconnect. So on behalf of AASB of I extend my heartiest thanks towards our today's speaker for sparing his valuable time. And I apologize due to this technical glitch, as that is not in our hands because of the bad weather in Odisha and a lot of rain and thunderstorms over there. So connection is got out. So definitely, I will request the speaker for his deliberation, and we will forward to the respective members. So thank you so much. Once again, I apologize because of the technical glitch as well as the natural reasons, which is not which are beyond our hand. So thank you so much. Thank you. Thank you.